Many equity traders and traders outside the interest rate complex, outside the treasury sector, have been a little disappointed of late with the performance of equities. Makes sense, and maybe even to some extent some of the high yield and investment grade corporates, the ETFs especially. I know that the security side on the spreads definitely have widened, but maybe not to the extent of past widenings that really should have caused the type of agita that we see in various areas of the market over the last several weeks. But there's a good reason to think, in my opinion, at least for 2018, that the high for rates may be in place. Now, what does that do to the other markets? Well, from a fundamental standpoint, here's my cornerstone of making that statement. The CFTC has been keeping track of open interest in the Treasury complex by speculators since the mid-90s. And pursuant to an article they wrote over the weekend, Reuters said this was the third largest reversal of positions, drops in open interest in that time period that they've been collecting data. That's pretty huge. There's also a technical aspect to this. We've covered it, but we're going to cover it real quickly again. 10-year chart since the end of September, we have a double top, and we've talked about that. And the double top now has taken us below 311, which was the first major high-yield close of the year. So everything is looking for lower rates. Now let's add in the notion of that open interest, and let's look at a big picture since 2012. And I'm going to give you a little Elliott wave here without getting deep in the weeds. You know, Elliott wave is usually 3 waves and 5 waves, and 5 waves is usually the trend direction, and 3 waves is usually the corrective. So you know that you're always going to have at least 3 big waves. Well, not only that, we have that double bottom from 2012 and 2016 at 135, which makes everything coming out of this more important. So what we have is 1, 2, 3, and we're in it now. And there's your little double top on this scale at basically 323. So to think that we're going to get a 4th wave is pretty much built into the cards, and if you think rates are going up, we should get a 5th wave that'll carry us higher in 2019. But should we only get a 3 wave and go sideways, there's still a very good chance of pulling this down. So the last major double top that we had was 3%. I would think that the cheapest return you're going to get on this trade would be 3%, but there is a good chance you could trade through it. And finally, the last reason, psychology. I think the other asset classes are going to spark up if they think that we're not going to make a higher yield close on the year, and ultimately that could give the end of the wave a little upside by New Year's Eve.